Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone gliding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market did amazingly well last week as the background news, which would in days of norm brought shudders to investors, barely brought a twitch. Monday, there was a down opening as news came out about Archigos, a family-owned investment firm that had some $30 billion in leveraged investments get absolutely killed. As those stocks fell very sharply that they were invested in, so did other firms that could have been affected by Archigos. What they had done was essentially had huge leverage by using swaps and putting up small upfront money, borrowing some $20 billion from banks, as I understand it. And as their stocks started to move down sharply, they got into forced liquidation, margin calls, and stocks like Viacom CBS went from 100 to 40. GSX went from 93 to 30. It was really a disaster in those stocks, and it just shows you that the overuse of leverage is far from gone in this world. In fact, it may be just as big as ever. And of course, that brought the ire of Janet Yellen, who was looking at this and looking at restarting the way that they look at the hedge fund market, so hedge fund industry. Stock market, which was really had a huge close the previous Friday, up 50 points in the last hour, opened Monday down about 34 points based on all of this news, but then rebounded throughout the day all the way to even, as buyers are clearly still here in the markets. Tuesday, stocks were weaker on fallout from Archigos, as Nomura and Credit Suisse both said they had big losses, but again, the buyers came back, and the market moved back up, and S&P 500 closed with just modest losses, though the Russell got slammed. It was down over 3% at one point, closed down just under 3%, and that just shows you that the third tier of the market has got some problems here, and we'll talk more about that as we go forward. Wednesday, there was a big rally as Apple got upgraded, and that brought a minor breakout to the NASDAQ as it was in a small consolidation, and we had talked about the potential for NASDAQ firming a bit after that consolidation, and that's what happened. But the market, which was up big, came up close to that 4,000 mark on the S&P 500, which is a resistance area, and selling came in at the end of the quarter, and that cut the gains in half or worse on Wednesday. Thursday, which is right now, we're recording this at midday, this is the last day of the holiday shortened week, and the bond market has a big update today, and that's bringing in the bids for the tech stocks, which has the NASDAQ up about 1.5%, best performing index today, and the rest of the market very strong as we see the S&P 500 move firmly through the 4,000 level, and that has the market now, as we look at this, up to about 4,011 here again as we do this show in the middle of Thursday. Expectations are for Friday that, of course, we'll all be off, that the payroll number that's coming up could be absolutely huge. I've heard some unbelievable numbers for the potential, so they're expecting a big number, and that could keep the market pretty firm today. And I'm surprised that the bonds are as strong as they are with that potential. Of course, Friday the market will be closed for Good Friday, and I want to wish all who celebrate a happy Easter and a happy Passover right now. So the stock market, let's talk a little bit about that. the stock market is rallying and now at all-time highs for the S&P 500 and the Dow, anticipating huge spending. And I've gotten quite a number of emails and comments on social media asking, well, what should we buy for all of this spending that's coming up? And I'm going to talk about that in a few minutes. Because that's really an important question. What should you buy, and if really you should buy based on the anticipated government spending that's coming up. They've already spent $1.9 trillion in the third COVID relief bill, and there is talk of a fourth stimulus bill that will follow after this discussion of infrastructure spending. So right, with $1.9 trillion already having been spent this year in the third bill, and now $2.3 trillion to as much as $4 trillion expected in the infrastructure bill, then the question is, what is the total going to be in here? And it could easily be for this year somewhere up around $6 trillion if they get all of these bills passed. And let's just say it's reasonable that it's going to be $4 to $5 trillion without even a fourth infrastructure bill being passed. And I assure you that the Democrats are not going to stop. And if they can pass this stuff at all, they're going to be looking at the next spending bill and the next spending bill, because that's really what they do. That's going to bring huge tax increases. I mean, the question is, how do they pay for it? Somehow they have to pay for it. Of course, there's always the argument that you don't really have to pay for it if you can print all the money that you want. But they do, have to have accountability, so they have to raise taxes and they have to borrow money. And the debt that we already have accumulated with this new debt coming on is massive. We've already seen the debt market factoring it in, with the 10-year yields going from 1% to 1.77% at its peak just in the last week. It's backing off a little bit now, but they really have to figure out where all that money's coming from, and that's really going to squeeze the corporations, as they also have to borrow money. And there's record amount of offerings coming out right now from corporations. So on top of that, which is going to be demanded by the government needs, the corporate needs, and we're really looking at interest rates going up even further. And we talked about this year our target being 1.6 and then 1.9%, and I actually could see it going to 2.4% sometime later in the year, and maybe even 3% by next year. So the Fed is going to be really challenged by the markets actually taking over, and the question is, are they losing control? All of this is affecting some of the sectors in the markets as rates go up, and the tech stocks act weak based on that, and the NASDAQ has underperformed. The Russell almost broke down this week, now bounced off of those lows, but is very significantly underperforming, and the spending that's coming is not that big a help to that third and fourth tier of the market, and higher rates because are really bad for that part of the market because they have such strong demands. Still, the S&P 500 moves through 4,000, as we anticipated it would, and we thought the market would be moving up into the spring. If you want to see what our targets are for the stock market, we have just posted our askSlim live replay on YouTube. So if you're not an askSlim member, if you are, you can see that right on our website, the askSlim live replay. Or if you're not an askSlim member, then you can see that by watching it on YouTube. And I think you'll find that 76 minutes absolutely fascinating. And you'll see our targets that we talked about for the stock market in there. But again, you really have to pay attention to these lagging sectors, and that could really cut this rally short, as the upside targets that we look at, the extremes, I think are going to be much, much harder to reach. So I anticipated that up into the spring, maybe May, early June, and we're just going to have to see if this market can continue to live on all of this huge expectation of spending, or if interest rate movement is going to cut it short And of course, there is the massive amount of high valuation that these markets, the stock market has. And when you start getting higher interest rates, you're going to get PE compression, and there's no way that the growth is going to keep up. And as a matter of fact, if you think about where we are right now as far as the expectation of growth, we have expectation of growth that could be as much as 6.2% rate coming up later in this year. So there's a huge disparity right now. Either the stock market is massively overpriced, or the bond market's massively overpriced, yields underpriced, and all of that could end up to be a lose-lose for the market. And that's the makings of some problems as we get into the second half, and we've said that before. So watch askSlim live replay, and you'll see some really great information and see what our upside targets are. Regarding the discussion on what to buy based on all of this anticipated spending that's coming from the government, we're going to talk about that in a few minutes as I look at something a little bit different that I haven't shown before. For the week, the S&P 500 up over 2%. The Dow about unchanged, or up just a small fraction. So you can see there is a disparity going on. The Russell up about 1%, maybe a little more on the week right now. So not a great gain there compared to the NASDAQ, which was way behind and now has had a catch-up as yields have pulled back some, with the NASDAQ up over 3% for the week. Bond market gains about a half a point. This all comes on Thursday, the last day of the week, where it gains about 1 3/4 points on the day so far. So exceptionally strong day for the bond market, and yields pull back with the 10 years down about 165%, losing 6-7 basis points on the week. Gold market, it recovers big also here late in the week. It was down a lot and ends only slightly lower on the week. The silver market is worse, and we had warned about the silver market for weeks that things were changing in there. It loses about 30 cents on the week, down about 1.2%, so it's acting worse. It was down to $23.74 as its low for the week, and it recovered $1 off of that low, so pretty significant comeback in what was some panic selling. And we believe that was an important bottom for now, but there are risks coming later in coming months in silver. And if you follow our analysis on FutureSpeak, which we do on Wednesday for members, that show where we look at 24 different futures contracts, you will see that we have projections that are quite a bit lower for the silver market over coming months. Oil loses about $1.20 for the week. It's the fourth week in a row lower, and we still see risk in there. And again, we talked about that in the FutureSpeak show on Wednesday, and I think if you do watch that, you'll find it very, very informative. That's it for the opening of the show. I want to make sure that you're familiar with what we do. Go to the askSlim site and explore the site. If you're new to askSlim, just join as a free member and you'll get some sense about what we do. Or there's a level 1 special that's just incredible. I'll show you a little bit more about that later. So become a free member or a level 1 member. If you're watching this on YouTube, subscribe to the channel and click the notification bell. We do many videos every week, and it'll let you know when we're putting those up. Make sure you like this video with a thumbs up if you are watching it on YouTube, and on Twitter, follow us at askSlim.com. You have any questions about our memberships and questions about the huge offerings of education and analysis that we share constantly every day, I'll give you a little sense for what comes out in a few minutes, then write to Matt at askSlim.com, M-A-T-T at askSlim.com. All right, so I mentioned on the opening part of the show that I've had a lot of questions about investing and what stocks would benefit from the Biden's infrastructure spending that's coming up. And it brings the question to mind, what's already baked in, question mark. Is it already baked in when you have a valuation of the market versus the GDP at historic levels, some 190% of GDP? I mean, it's just absolutely mind-boggling how overvalued this market is. And of course, it keeps getting more overvalued as they keep moving up, and there's an anticipation of strong growth, and that's why the stocks are going up. And they're trying to buy things that are recovery stocks and things that are value stocks that likely will move up. And of course, there are the benefits that you'll see in industrials or energies or even the utilities infrastructure stocks that will do well based on the money that the government is about to spread like fairy dust all over the whole economy. So it's a hard question to answer, whether or not it's already baked in. And then there's always the question of, are they buying the rumor, and then will they actually sell the news when that comes out? At some point, they're going to say what more can happen as far as spending, and there's always the chances that the more centric Democrats will block some of these things, like Joe Manchin, who could get in the way of some. And he says if there's no way he would allow anything to pass as far as excessive infrastructure spending if it didn't include Democrats, if it didn't include Republicans in the bill also. So we never know where that's all going to go. So you're almost getting to where it's, a near a lose-lose situation for the market, as if they can't pass it, the market goes down. And if they do pass it, well, it could be sell the news. So can the market go from 4,000 to 4,500? Well, I suppose anything could happen in this crazy world, but it's not likely. So a lot is getting priced in right now. So you have to consider, is it late to be making that kind of play? And that's how I answer some of these people. But still, I want you to be able to have an understanding of the market condition and how you really know. And to do that, you really need to focus on some broad measure of the infrastructure spending. Money flowing in will raise earnings, and with thousands of stocks already having benefited, is it, to 1 or 2 or 5% more could get up on the upside? You could really get into some traps in here. So I want you to really be able to focus on some broader measure. For example, if you picked out a handful of stocks that could do well in the next 5 or 10 years, you could really get run over in the meantime by this overbought situation. For example, Caterpillar, which is a great infrastructure stock, has gone from a low of 90 to 230 in this move. So it's been massive. And when you look at the material stocks and how much they're soaring, and stocks like U.S. Steel exploding to the upside with massive percentage gains, and of course they lose money, and it's hard to, you don't know if they're ever going to make money again. Well, maybe there's a better way to invest and a better way to track it, and we're going to look at that. So that was kind of a long introduction into what I'm going to show you right now. But I think these are all valuable questions. At the same time, I'm going to do a little teaching around cycle analysis, which is the core of the analysis that we bring. And it's always involved in momentum analysis and picking out the important support and resistance levels. And we have a lot of ways that we do this. So I want you to look at this chart of this important ETF. So again, if you're going to invest in infrastructure, maybe you want to do it in a much broader way. This is the U.S. Infrastructure ETF, IFRA. This is the iShares Trust ETF. This is an example of cycle analysis. So just for the people that are new in here, on the bottom what you see are cycle brackets, these right over here. And what they show you is the money flow. In other words, when money is moving in and when money is moving out. And the ideal cycle would move up half the time and then fall half the time. And I'll show you that on the daily chart in a moment. And then when you get into a trend, or when you get into breakdowns of trends or breakouts, you get into significant moves. Here's an example of a positive cycle, and a positive cycle that broke down under what we call a VTL. This is the valid trend line, which comes off of the individual lows or peaks from cycles. And once it broke under there, of course, we got into that massive deleveraging back around the COVID panic, and you had that huge break. This is called a basing cycle, where it comes up sharply, it comes down and hits the support zone, and then completes based on the timing. These vertical lines are the actual lows, as you can see in each of these cycles. And then the brackets show you the average cycle distance. You can see here this cycle bottom comes perfectly in line with where this projected average cycle low would be, and here is the new cycle that we're in. So let's just take a look at these last couple of cycles right in here, and you will see that what we're projecting based on this is that that there will be a continuation. Now we look at momentum, which is always key. This momentum indicator right here is telling you momentum on the weekly chart, and we're looking at a 10-year weekly, is still positive. You can see in here this VTL connecting these bottoms, pointing to the upside. So if the VTL would break, it would be the first warning. And you can see the VTL is rising because that really kind of matches the trend that you see in here. So that would be the first sign. If it broke and then got some support right over here in the support zone, it would still be okay. It would have to break under this low over here to be negative. And it's quite a ways from that right now, very significant percentage away. So now what we're projecting, and remember we were projecting the stock market to continue rally into the spring, is to get up towards the fib extension target zone. This fib extension target zone was built off of this cycle, and you could see it came right up and touched the bottom of it, and then came down and corrected only to the 23%. This is what's called a right-hand translation, a very swamped cycle that is swamped by the upward momentum as money flow continues in here strongly, and then it moves up again. So the target right over here is around 37 on the upside. And this points out to this April-May period where it's likely to continue to the plus side. So as long as you're looking at infrastructure, this gives you a very, very good sense that the market still looks okay, the infrastructure stocks still look okay, and this particular ETF tracks about 150 or so of those stocks, mixing it up between industrials and energies and materials and utilities and things that will benefit from all of the money that the government will spend. Now let's take a look at it on a daily basis, because we're going to continue this important lesson. And you can see in here now we have a little bit more information, because what I want you to see is, and we'll continue this cycle analysis lesson also, are the momentum conditions, which have been very strong, and the cyclical formations. You can see in here the period in the cycles right there and how they line up. And you can see that they continue to be positive. This one was a neutral cycle right here, but the rest of them positive. This is the slim ribbon right in here, which is one of the best momentum indicators you will ever experience. When it's all lined up on the upside, the probabilities are high that it's continue rallying. Here you could see on the bottom what's known as the slim ribbon PO. This is the signal indicator for the slim ribbon and tells you when conditions remain extremely strong or extremely weak. In this case, there really is, through this whole period back through last October, there was no negative periods at all. It turned neutral during some corrections and then continued to give you these positive signals. Again, we're looking at this target zone here. This is 36. This right over here is 36.77, and this is from the weekly, up around 37 even. And we still continue on the upside. Now let's talk a little bit more about cycle analysis. These are the cycle brackets, as I said, on the bottom. Now, if the cycles were neutral, each of them would go up half the time, down half the time. So it would be kind of this equal channel that I put in there, you could see. But if you tip the channel upward, essentially, and I'm just going to grab this and just make it a little bit bigger so that you can see. So there's kind of the idealized look. But if you tipped it upward, you can see how it then affects the cycles, as you can see that it's done up above. So this shows you the upward momentum in there and how it actually affects the cycle patterns. And this is the key to understanding money flow as we look at this, as This takes the ideal pattern cycles and then moves them into rising trending cycles, as you see right there. And each of these basically positive, neutral, positive, positive, and then very likely will take out the next high. Each of these higher high, higher high, higher high, higher high, all of those, and likely to go to a higher high. If this pattern changes, in other words, you either don't make a higher high or you then break down and make a lower low, and in this case, it would need to get underneath this last low right over here, and then you'd have a breakdown underneath that level. Then that would tell you that the infrastructure investing is over. And that's the key to this analysis, is looking at the multiple time frames that you see right in here. I just want to blow this up somewhat, that you can see that rising here on the weekly, rising here on the daily very, very clearly, and this upward trend, the market will tell you when that's gone. And right now it's telling you that the infrastructure spending is still strongly in place as we continue to move on the upside. For our members, you can check with me on this. If you don't have this analysis, our level 4 members can request this from us, and I will send you these Thinkorswim charts to put up on your platform. That's only for level 4 that we provide that. So again, I think this is great information about this question about infrastructure spending. I believe the market is overpriced. I believe that there are a lot of things showing cracks. But while you have this spending going on in these stock sectors that are driving this index, the market is still going to be in good shape. So I think that's very, very important analysis, and it really answers this question about investing for infrastructure spending. Should you still do it, and how do you do it? Well, I think you need to do it diversified using an index like this. There are other infrastructure spending indexes, but I just happened to pick this one to bring to you. So that is a look at what I think is very, very important analysis. All right, we're going to look at something also a little bit different in here. I want to look at commodity ETFs. We've really had the stock market being very, very strong. You know, we're really looking, my last discussion about infrastructure spending and looking at this type of analysis where you look at kind of shorter term and longer term, and at the same time really understanding momentum, which is the key to your success. I think it's important to understand momentum in everything you look at. So we developed our momentum tracker, and I just wanted to take a peek at the commodity ETFs so you could see which ones are really strong and which ones are really weak. And I think that you're going to get some good information out of this. To do that, I'm going to go to the askSlim website. Here you can see the front page of askSlim right over here. And what I'm going to do is I'm going to click on My Workbench. That is really the hub of askSlim, and we're continuing to put things in there. I'll give you a little peek of some of the things that we put up all of the time as I go into the workbench. And here you could see the every time we put a post up, it shows right in here. So these are just what you could see: level 4 chart request, level 4 chart requests. We do custom analysis. We posted a trade idea in here, which RV did a video on and put that up. Another trade idea on these on the biotech index right over there, and here you have level 4 chart request, future speak minutes. So you can get an idea that we post so many things up there. This is a level 4 workbench that you're looking at, so there's a lot of things that are posted in there. I'm going to go to the momentum tracker right over here because that's really what I want to look at in this analysis. So I'm going to go up in here. Now the momentum checker's got tons of stuff in here, and just a huge amount of abilities to do scanning and sorting in over 1,000 symbols. But I want to go into the watch lists right now, and I'm going to go down to the bottom watch list, which is the futures ETFs right over here, and I'm going to select that one. So what this does is it's essentially live scanning based on all of our algorithms. We look at long-term, intermediate, and short-term algorithms, and we bring into that some of our other proprietary studies, and there's an output then that comes and it gives you our directional bias. We can actually give you the directional bias ratio. It's not as valuable when you look at commodity ETFs because there's so many sectors in here, but when you look at a single sector, it's really valuable. What I want to look at right over here is directional bias, and you'll see I'll flip it up and down. And here you can see that when you look at the Dow Jones Industrial Average, it's a strong positive conditions suggest minor declines in higher prices over the next 3 months. So basically, I've been showing you rallying for the stock market out into the springtime, and this is very reflective of that. Very, very strong momentum in all time frames. The S&P 500 and the S&P 5, the Dow Jones and the S&P 500 have the same very, very powerful conditions in here. I want to kind of scroll down a little bit so you can see that when you look over here, that the IWM is different. And what happened is that the short-term reading has turned negative, and you're only neutral on the intermediate term. So you only get a very slightly bullish, and you have mixed conditions in there in the Russell. So you can see that the Russell conditions are not as good. You wouldn't want to be buying Russell based on that. And you see QQQ right over here. It's the same thing, but it's neutral on the short term. So it's not quite as neutral. It's slightly more positive than you look at the IWM over here, which is negative at that point. I want you to look at other things in here, and I'm not going to spend much time on this, but the very bearish things that we look at in here are gold, as you can see right over here, very bearish. FXY, the yen, is very bearish also, as the dollar's been super, super strong. So you can see all of this great information available to you. Of course, we know that the bond market has been plunging. The shorter term is now neutralizing. So it goes from very bearish to bearish, but it is still in a pretty negative condition. Interesting here that natural gas, which we think is bottoming, is still showing you bearish conditions in here. And if you saw future speak, I told you that it's not quite ready. It has work to do. So here you see the very, very bearish and bearish things that we look at right there. And here when I flip to very, very bullish, you can see. And you can scroll, you can do the same thing here on the long term when I just scroll on long term or intermediate term right here, or the short term right there. And also we have some charts in here and other things. You can also, if you want to put in individual symbols, I'm just going to go to single symbol mode, and I'm going to type in IBM, let's say, and you can see IBM is really very bullish. So we have 1,000 stocks in here, but I really wanted you to see those commodity futures because I thought that was really extremely interesting. Again, this is the Slimulator Momentum Tracker. It is an amazing app that we have built. Just a little bit of promotion that I'll do in here is that you could actually, if you want to use that, and if you're a position trader or longer term trader, or you just want to get a good sense for the markets, you can just, if you're not a member, you can sign up for our level 1 special. It's $14.95 a month, $30 for the quarter. Just go to the website. It's easy to find. Just scroll down on the main page. You'll get the Slimulator Momentum Tracker that I just showed you. You'll get our weekly stock index report, our weekly spider report, our new trader investor workbench where you can organize and prioritize and save and track all your analysis. You're going to get our Market Week show archive, all of our replays for our askSlim live shows, which are just amazing. You can get a sample of that because we posted one on YouTube for this week just so that you could see what we're doing, and some special member videos. So if you have any questions on that, write to matt@askSlim.com. But this is just amazing. I mean, sign up for $30 for the quarter. It supports us and just supports you and all of your learning, and you'll really be able to keep track of a lot of things that we're doing and we're bringing out. So that's our Slimulator Momentum Tracker, the commodity ETF conditions, momentum conditions I shared with you, and this opportunity to become an askSlim member. All right, so we're going to look at the S&P 500 and the VIX on the short term. Stock market moving up to an all-time high right now. As we record this now with a few hours left to go in the market on Thursday, the last day of the week, and happy Easter and happy Passover to everybody who celebrates out there. And this information I think you're going to find really interesting, because the value of using the stock market index and implied volatility will be seen here pretty clearly, because the correlations are important, especially when you look at cycle analysis. So I think you're going to find this quite interesting. I'm going to go to a daily chart of the S&P 500. There's that IFRA, and if you're just watching this clip now for the first time on YouTube, it's important to go watch this analysis on IFRA, which I did earlier in the show. So we're going to go to SPX, and we're going to look at the cyclical patterns that we see right in here. So these are complex cyclical structures that we're looking at. On the bottom, the cycle brackets, and the actual cycle lows show up on those dotted blue lines. We've had an average of about 30 days, now tightening up to about 28 days on these cycles. And we have a mid-cycle lows that have been showing up right around the 13 to 16 day area, as you can see right there. This one was 14 days off of this low right there. That's the minor lows here and here and here. And you can see one right over here also. So now we're in this second minor rally right over here, and we've moved up through what were our projections there based on the level of the fib extension there right over there. It kind of got through it here and then rejected here late on Wednesday, and then Thursday now it's moving up through it. Now our target right over here was about 30.81, 30.82, something like that, and now it's moved up through that, and the high was around 40.12 today. For those of you that have seen our weekly SPY analysis, we were looking for about 410 to 415, and then the next level was about 485 to way up over here. So this right over there is about 485 in the SPY, 408 on the SPY, to this level up here about 411 on the SPY, and this is 4085 to about 41 over 4100 here, 4140. Right at that level. It could make it up there, but we're getting into a period right over here where there's a likely pullback. And why do I say that? Well, the period of risk is when the minor cycle and the dominant cycle come down together. You can see that right in here, and right in here, and right in here, and then likely showing up right in here. So this, as it moves further away from the slim ribbon right in here, it starts to put the distance on, which then calls for kind of a mean reversion, and you start to get a pullback into this corrective period. You can see in here the slim ribbon, how this bullish signal came right in here on that arrow. It turns the slim ribbon PO positive, and all of these bullish signals that we see in here turns neutral on these corrections, and it's probably going to turn neutral again. So what we're looking at now is for this corrective period to come into play, and then moving up again. It's just modest. We'd say 2.5 to 3.5% pullback in here that probably gets you down somewhere in here to about, we'll call it 38.95 down to about 38.60. So that would be approximately 120 to 150 points in the S&P 500 over the next week and a half, and then moving up again. So this is a short-term view. We're looking at about the next two, three weeks as we look at this, and the likelihood that this will not extend up into that higher projection there, but the potential for that to happen out over here. Remember, we're looking for higher prices out into spring, so that would not surprise us. So this is a bullish configuration as we look at it. It would take a move down below this area of 37.23 in order to get negative. And there's not much of a likelihood of that unless we get into some very, very strange panic. So while you see that these cycle structures continue to be positive, projecting to higher highs, the next one over here is likely to do the same thing. When I put up the VIX, now you would expect that the VIX would be giving signals of something that's negative. So here are the daily patterns on the VIX. Now there's something important I want to show you looking back a little bit further, and that is when you look at this huge advance in the VIX, and then That happened a year ago, March, in the panic when COVID hit. Then you had that next VIX cycle right in here where it rallied up a little bit and then took out that low. That projected to the VIX declining all the way through this period right over here. And you could see it exactly did that. Here you had the same type of a pattern, but more sideways, and this more sideways also. And what you see going on right over here is really important to note, and that is similar to what we saw a year ago. You had this big upward spike in implied volatility, and now this cycle turning negative. That projects to lower implied volatilities, or a choppy trend in implied volatilities that takes you out where? Out to this period right over here, and I'm going to highlight the dates, May 16th, May 16th, May 16th. So like we said, we expected the stock market to rally out into sometime late April through early June. This points to May 16th as the end of the downward trend in implied volatilities. So while I'm thinking that the stock market has a pullback coming in the next couple weeks, maybe you get implied volatility popping up in here now. We've downgraded this based on cycle shapes. I want you to see that. On 331, we downgraded it. And we're looking, instead of what we were looking for, to a pop into the mid-20s or high 20s, now you see this declining wedge that's built in here, and more of a likelihood that it can't get really much over the 20 to 22 area before it then moves down again. So maybe you get a brief uptick here in implied volatilities over these next couple weeks, then it begins to come down again. You can see the wedge, you could see the negative conditions here in implied volatilities, and that matches up very well with what we're talking about in the S&P 500, which we expect these upward conditions to remain in place. So again, what we're looking for in the next 1 to 3 weeks is a topping in here, a pullback of some 120 to 150 points in the S&P 500. We'll just call it a 2.5 to 3.5% dip, not much, and then another positive structure following after that. I hope you found that absolutely informative and amazing. You want to learn about cycle analysis, go to the askSlim.com website. And go to the workshop tab and click on cycle analysis workshop, and we have a video in there that explains it. Matt has more videos and things if you want to write him at matt@askSlim.com, and he will send you some information on our cycle analysis workshop. That is it for the week. Again, I want you to have an absolutely great holiday. I want you to be so unbelievably careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been